Thanks again for being here, everyone. And thank you to our speakers for being here today. So today's topic is going to be about the macroeconomics trends and what the outlook is and how it impacts VC investments and startups. Now, before we dive deep into it, I think it would be good for us to do a quick self round of intros so that the audience gets to know us a little bit better. I'll get started first. So my name is Jane. I am the startup partner lead at Stripe, and I look after accelerators and VC partnerships across Australia and New Zealand. I also help startups grow and scale through Stripe. I'm also currently a founder and managing director of Co & Co Property Development. And previously, I was the ex-founder of a food rescue platform called Bring Me Home. And over to you, Jodie.
Thanks, Jane. Hi, everyone. So good to be back in a room with you all. So my name's Jodie. I have been running businesses for 20 years. My first startup I built with Imam, who's sitting right here in the front row, called Occasional Butler, and we sold that to Airtasker back in 2014. We also started one of Melbourne's first co-working spaces back in 2012 and ran that profitably for 8 years until March 2020 when we made the quick and brutal decision to close it down. I'm now co-founder and co-CEO at Skalata Ventures, and we are called Tractor because we like talking about tractors and rockets. And a rocket is obviously very exciting, and some of them land on the moon, but they're also very expensive, and a lot of them blow up along the way. And this is very much the VC model, and we love our VC friends, of course. But we like tractors who we've found are still very ambitious, but more sustainable and working at a pace that suits them and their customers. And so if you were to say to a farmer, I'm sorry, we're going to take away your tractor now, she or he's most likely to be pretty upset. And that's the kind of relationships our founders have with their customers. So their software becomes very sticky and their customers rely on it. So we started 2 years ago. We've deployed $20 million so far to 75 founders. We really exist to unlock possibilities for founders. And so we've started with revenue-based finance, which is basically a loan that you can pay back with a percentage of your revenue. So it's an alternative to raising VC capital, which doesn't suit everyone. And you can save on dilution as you build the business. So we are writing checks between $50,000 and $1.5 million. We basically need you to be doing at least $15,000 in revenue as a starting point. We also have an advisory side of our business too that helps unlock other possibilities. Thanks.
Hi everyone, Ben Armstrong here. So I run a venture capital firm called Archangel, and we're pretty active in the early stage community. If you haven't heard of us, we should fire our marketing team. No, we don't actually have a marketing team, so that's fine. I can say that and no one's going to be offended. So we've made 42 investments over the last few years. We've deployed about $10 million of capital. We backed 91 founders. Our last investment was 27 days ago. I've seen a lot of things in venture capital. I've been in the industry for about 10 years myself, done a bunch of things before that. The startup I founded failed in the dot-com crash, which to some of you is just a theoretical thing. For others of us who are a little bit older, they might remember some of those heady times before and the bleakness that occurred afterwards. Looking forward to getting some good questions today to the panel. Thank you.
Hi everyone, my name is Rohan Workman and I'm the CEO and one of the co-founders of Skalata Ventures, which is a seed stage venture capital firm. We started in 2018, we've made about 50 investments. Our investment mandate is to invest in companies that are innovative, capital lean, capital efficient and market ready. So we've invested in companies that haven't had any revenue and companies that have been turning over up to $70,000 or so per month. Prior to that, I was a founder myself and started a B2B SaaS company, which we sold in 2016, and have also worked at the University of Melbourne running on early stage programs to support entrepreneurs there for a while. And that's a big part of Skalata Ventures. We are big believers in seeing Australia transition to a knowledge economy, and we think that universities have a really important role to play in that. And so we work with our 6 university partners in Victoria to try and help encourage more entrepreneurial activity out of the university sector. And alongside the capital that we provide to our founders, we provide a lot of support to help them build significant and sustainable businesses to ensure that they're putting themselves in the best possible position to raise a Series A or continue to bootstrap the company if they'd like to do that.
Thanks, everyone. So I guess to set the scene, we everyone here probably can feel that the macroeconomics changes are coming in like a headwind, and interest rate is at its all-time high for the last 10 years, and we can all feel the inflation hitting our wallet when we shop at our local grocer. So it's inevitable that startups will feel like that this is actually a very tough time to thrive with the current economic environment. But what I'm curious about is, has these macroeconomic trends affect how you invest in startups or your investment process at all? Jodie, would you like to answer that?
Yeah, sure. Thanks, Jane. From internally our perspective, it's actually been a tailwind for Tractor because there's so much nervousness in the VC funding environment that founders have stopped being curious about this kind of alternative and started to be very serious about it. And so for us, we've experienced a tailwind, and I think that's something to consider in all of this talk about this downturn, that there always are winners and losers in every stage of the cycle. And I think too, for our portfolio, mostly they have business, they're B2B, so they have business customers, and that hasn't trickled through yet. So the way we're looking at it is to think about what risk they might have in the next 12 to 24 months, rather than what it hasn't hit them yet.
And that's a very interesting perspective as well, because Tractor, it is a debt financing alternative for startups. Now, Ben, I'd like you to also answer this and see if this has actually impacted your risk appetite at all, coming from an equity point of view.
Yeah, I mean, not for us specifically. I mean, we're still very active. We make about an investment a month, or sometimes two. But I think what it's caused is the whole market to reassess, like, what is a venture scale opportunity and what isn't. Like a year or 2 years ago, everything was very frothy. Everything was very positive. Interest rates were low. It made sense for investors to put a lot of money into things like venture capital to get a return. Now it's pretty easy to get a return just by putting money, in the bank, and get a reasonable, rate. Whether it's above or below inflation is another thing. But so I think lots of VCs have sort of stepped back from doing the easy thing, and they've now said, well, instead of just following the momentum of the market, let's look at the fundamentals and let's go back to what is a VC type opportunity. And that's why I think you've had a pullback of some VCs who have we've deployed tens, hundreds of millions of dollars. Now we've got to be a bit more respectful of our LPs' money, because don't forget, Rohan and I and even Jodie, we've got investors who have probably felt a bit of the impact of the market change on their finances, and they're the ones that we're accountable to because we're investing their money.
Yeah, that's fair enough. And I think a lot of sometimes founders probably don't really think about, the other level of investors that the VCs have to report to as well. And Rohan, I'd like to ask you this question. So what type of challenges are you seeing right now from your founders and your portfolio companies? What sort of challenges are they facing now, and what sort of advice are you telling your founders?
It's a great time to build a company, is the first thing. The second thing is one of the challenges every founder is going to face is it's going to take longer to raise money, and it's going to take more conversations to do that. A lot of people who were, as Ben mentioned, more active in the last 2 years, which were stupid. A lot of people who were more active in the last 2 years have now taken a step back, especially a lot of angel investors, because they're just, whenever there's any volatility in the market, a lot of people take their money out of it. And so just if you're a founder, an early stage company looking to raise money, then the thing you should be prepared for is to have more conversations to raise money at a more sensible valuation than has happened in the last couple of years. So they're two big things. But the other thing here is that it's probably easier to stand out to investors if you are disciplined about managing your cash flow and if you're realistic around the growth expectations of your company, and also have a plan B if things don't work out according to what you're setting out to achieve. So I think it's actually a really good time because there's a lot of people, including the three of us sitting up here, who are probably going to make more investments this year than in any year we've made previously. So it's actually a great time to be raising money. Exactly. Why? Because it's not as stupid as the last 2 years. Honestly, there were so many, you'd get these founders coming up to you saying, I'm turning over $4,000 a month in revenue. I'd like a $10 million valuation. I'm going to build it to a $100 million company in the next 3 months. It was just stupid. And the thing was, what was happening was there's a rush, and there's a lot of FOMO in the market at that point, right? So a lot of other investors, and especially if you think about angel investors, we're all professional investors here. And because we all invest at the very early stages, what happens is we generally compete with angel investors. Angel investors have to be high net worth individuals. You get a lot of people who are maybe doctors, bankers, lawyers, people with money who don't necessarily understand in detail what it takes to, be a successful early stage investor. And so what you find is some founders might find a friend's uncle who works at KPMG as a partner, put in money, didn't know that for a $10 million valuation wasn't actually that sensible. And it sets an unrealistic expectation around what they think they can get for their next capital raise. So I think it's and now that those investors are starting to take a step back, the whole, world, especially the seed stage, is a lot more realistic. And what you want is when you're thinking about building your company, what you don't want to be doing is optimizing for evaluation right now. You want to be thinking about the next 4, 5, 6, 10, 30 capital raises you need to do to build the company that you want. And you want to be building an incremental pathway to make sure that every capital raise you do is one that's higher than the last one. So if you optimize for valuation now and you don't achieve the targets that you hit, you're going to be doing a big down round for the next valuation, and that's not in your best interests.
And also, if you've diluted yourself too far along the way, then you just a turn off to investors in those later stages. So you've got to really protect that dilution from the start.
Jodie, I'd love for you to also expand on that. Are you seeing the similar challenges that founders are facing from your portfolio companies? And what sort of advice are you giving it to your founders right now?
Yeah, I mean, we're actually seeing some really great opposite experiences. We had one of our founders say to us, okay, I'm ready to raise in December last year. And we're like, you're crazy. You're not going to get money in December. Anyway, he did. He got money from 1013 and some others, and the rest is finalising at the moment. But I do think that it is a great time to get investment if you are a business that has customers and is producing revenue and it has a path to profitability. There is a lot of dry powder in this market, especially, and Australia is still protected from what's happening to an extent around the world. And I think our VC funds are cashed up and have to invest.
Yeah, thank you for sharing that. And Ben, so a lot of founders that I speak to, they say, oh, this is the best time for VCs because, our valuations are getting slashed. They can, I guess, invest more in startups, but at, the detriment of their equity cap table. Any thoughts and suggestions on that sort of statement around this is the buyer's market, founders should be holding back, and if they can, they should be timing the fundraise?
Yeah, and I've got a few thoughts on that. I mean, I certainly don't think of it as a buyer's market. Like, I think that's the wrong attitude. Like, I think you've got to raise money when you've got something exciting happening with the business. Like, that's the first thing. You've also got to raise money before you're going to run out of money if you need money. So, like, please, like, don't wait till the last minute and then expect people to fund it in like 2 or 3 months. Like that does happen, but rarely. Like, often a raise takes place over a much longer period of time. So, if you need money, start the process early. I don't think I'd change my advice on that at all. And I think in this market, there's lots of opportunities for VCs, and like Rohan was saying, valuations got silly. Don't anchor yourself to 12 months or 24 months ago. That's just not the market we're in. But every business is different, and you've just got to have the conversations with the market, with the VCs, with the angels, with the other, alternative funding type groups if you want. and find out, what the market is saying. But like no one's sitting, like we're not sitting there going, oh, now's the time to strike. We're gonna make a whole lot of money in this market by beating down startups. That's not how we think. We think the long term. We don't make money for 7 to 10 years, right? This is a long game for us. And while it's great that we can find more opportunities, in the market if there are. Like it's a balance between valuation, people who want to take a risk in this market, and like Rohan was saying, I think it is a great opportunity to start a business in this environment if you've got the right kind of business and you've got the right kind of attitude.
Yeah, and this is a question for all three of you. So some of the startup founders in this room is preparing or thinking about or in the middle of raising capital now. What would you say in terms of managing expectations, in terms of how to best position themselves for when pitching to VCs or in the middle of negotiating a deal? Jodie?
Yeah, I think being passionate about what you're doing and having that conviction about your plan, but also being realistic and sort of having those mitigation strategies for potential risks that might come up in the next couple of years. It's that sort of realism, I think, that stands out at this time.
Ben?
Yeah, I mean, I agree with what Jodie was saying there. I think it's, I think if you've got the right attitude and you're not like overly sort of starstruck by the whole, founder experience, and you have plans both for the sort of short-term survival and the long-term, VC type returns, that's what people want to see. And I think people are more realistic. VCs will be more realistic now, investors in general more realistic now about growth rates in this broader macroeconomic environment that we're in.
I'd say run a process. So raising capital is like an iceberg where most of the work happens under the water, and the actual raising of the money is the stuff that sticks out the top of the water. So rule of thumb, 12 interactions with a person if you want to raise money. Interaction can be a cup of coffee, could be an email, could be a quarterly update that you send them. Get a quarterly update together, find out people who might be interested in investing, share with them what your plans are on a regular basis. If they see that you're achieving your plans and that, yes, you'll have obstacles that you'll overcome, they'll feel like they're getting to know you and your company and what you're capable of achieving. And when it comes to actually raising money, run a process. We're now looking to raise money. We're going to be taking, pitch meetings from this date until this date. If you'd like to, we'll open a data room. If you want to see information, it'll be open from this date to this date. Take control of it. Don't just go around with a cap in hand to investors saying, hey, please, can I have some money?
Thank you for that. And I know this is kind of a heavy topic. So I like to, before we go into audience Q&A, I like to just kind of, round up with a bit of a positive note that, there is a saying that in midst of chaos, there will always be opportunities. So again, this question is for all of you. Where do you see the opportunities lie, and how do you think founders and startup operators can really take advantage of times like this?
No, I'll make a stab at it. So I'm not going to tell you where I see the main opportunities in this environment. That's for you guys to work out, right? I don't try to seed the market with opportunities. But I think in any change of market, there are a ton of new opportunities, sort of business models that work in this environment that maybe didn't work in a low interest rate environment, and vice versa. So I'd encourage you to look for customers out there who are resilient, who are showing that there's a need for the service or product that you're thinking of doing, because that's a really strong signal for any investor. If customers are jumping at what you're doing, if they're not cancelling, if they're actually buying more with minimal marketing, that's like catnip for investors.
Rohan?
No, I'm not negative at all. This is the best time to be starting a company. Slack, Uber, Airbnb, Hewlett Packard all started during economic downturns. So do not be negative. This is the time for you to actually build a bloody great company just assume it's going to take a bit longer and might be a bit harder to raise money than it was in the frothy last couple of years. But this is actually the time when you should put your head down and get into it.
Jodie?
And I think, yeah, like if you've got customers that really need what you're offering, that's great. I think the other bit of advice would be to think about, especially if it's a business to business model, like think about your customer's customer, and if they're a consumer, what are they potentially going to be cutting off that service, and that's going to then affect your direct customer and then affect you. So that's what we're doing at the moment to manage our future risk, is looking at our companies and then their exposure from their customers to see what might filter through over the next period of time.
Thank you so much for that. So that's all my questions. Now we're going to go into audience Q&A. Thank you for those that have been submitting your questions in Slido. I've got them right here on my phone. So I've got a question, and feel free to jump in, anyone. So someone anonymously asked, have the VCs seen LPs renegotiate their commitments in the last few quarters? And I'm going to maybe add an additional question to it is, do you think that the macroeconomic trends will actually impact your fund in the next 18 to 24 months?
I'm happy to start on that one. No, LPs won't renegotiate their commitments, because if they do, they will be absolutely punished by the terms of the investment documentation that we have with them. So basically what happens is a lot of venture capital funds might raise $100 million. You might do a capital call for the first $10 million. And that means that people are on the hook to provide another $90 million. If they renege on that, they lose the rights to the $10 million, generally speaking, that they've already invested. So that's not going to happen. But what will happen is, over the last 5 years, there's been a bunch of venture capital firms that have started in Australia, and over the next couple of years, some of them will go out of business because they've probably been making investments at too high valuations, or they can't raise money, or whatever it might be. There's tons of different reasons why that's possible. But there will be fewer venture capital firms in 2 years' time from now than there are now.
Sounds good. And for the next question is, so for a pre-seed or seed round, what is more preferred by angel investors or VCs? Would it be safe notes or C notes? And what's more beneficial for a startup?
I'll have a go. So, we're not particularly worried about the investment documentation. I mean, we've seen everything: priced rounds, safe notes, SAFT agreements for Web3 things, convertible notes. So, the instrument isn't so important. It can have an impact on the timing of the raise. If it's a priced round and you don't know what you're doing, you have a bad lawyer, it can blow out the fundraising process for months, which is really frustrating. So, I'm still a big proponent of a safe note, but no one really cares that much. I mean, safe notes have the benefit that they're designed for speed and designed for early stage investing, which is why I probably have a slight preference over convertible notes.
And this is a very interesting question upcoming. I'm going to maybe rephrase it a little bit. Is there a specific sector or business model that would look super sexy right now for investors given the current market conditions? We all hear B2B, SaaS, enterprise, MIR, like those are the terms that VCs love. So what does that mean for any other sectors or startups that are working in like B2C, D2C marketplaces? Any thoughts?
There's the boring sectors are the best. So if you're working in a really boring industry, then we really, really want to talk to you, because they're often overlooked. So one of our best performing companies is a logistics company. So that's really exciting. I think if you're doing D2C or anything consumer related, then you do need to be considering the macroeconomic conditions and the fact that people probably will be spending less over the next period of time. So growth rates will be lower.
I'd also say, don't be too nervous to have a hybrid model. We see a lot of that at Tractor, where our founders have started off with more traditional model, like a consultant or a service provider, and then have found the technology that's going to solve the problem and are translating into a product business. And so that's the sort of business we can happily support. And that diversification of revenue across different models is also something that I personally think is a great thing to have.
Yeah, no, sort of flip it a bit. I mean, you probably watched how sort of VCs sort of all jump on the next great thing, whether it was NFTs and Web3 a while ago, or now it's all generative AI that everyone's raging about. You don't need to have a startup in those hot areas. Obviously, it appeals to the sort of thematic investor who's trying to sort of follow the next big thing. But who knows where the next big thing is going to come from? Certainly not VCs. We rely on you guys to find the opportunities in the market from talking to real customers.
Thank you so much for sharing that. And someone sent in a very interesting question, actually. So from a founder's perspective, it's a catch-22, given current times. One, inflation means expenses will grow. And two, it's also harder to get money and more expensive to get money, especially debt. So how can this be a great time for founders to raise? And I guess, from the VC's point of view, how can founders sort of shape that perspective a little bit? Does anyone want to?
I want to be clear. What I didn't say before is it's necessarily a great time to raise money, although I think you will find you can raise money. It's a great time to build a company. And I think a lot of people forget that capital is just a resource that you use to build a company, much like office space or people or electricity. And if you have one of the good things about Australian business models, or Australian founders in particular, especially compared to Americans, is that we tend to be able to do more with less and are more resilient when times go bad. Because we're a bit more scared of failure over here. We don't have that risk tolerance that they do overseas. So I think it is, if you have sustainable growth, that is the most important thing. And if you have that, you will probably be able to raise money. Yes, interest rates are higher. Yes, the cost of capital might be higher. But the other thing is, if you think about the cost of starting a business 30 years ago, 20 years ago, 10 years ago, 5 years ago, it was dramatically higher than it is now, because there are so many services that you can buy off the shelf for a software as a service from the cloud that you couldn't do previously. So there's tons more opportunity to actually reduce the costs of the inputs into the company that you need to.
Absolutely. I think that we spent a small fortune building a marketplace in 2011. Now you don't have to. And I think the reason it's a good time is because if you can build a business in this environment and a solid foundation, then you'll fly when it's a good environment.
Yeah, and some of the founders here have been submitting questions around what's the non-negotiables for pitch deck, and what's the actual time frame to raise right now. I think before the market conditions hit, it was on average 3 to 6 months, but now it's definitely a bit different now. Does anyone want to give this question and go in terms of how long it takes to raise, and what are some of the non-negotiables on a pitch deck for seed stage?
Can I just answer that with slightly off on a tangent? But we're talking to lots of founders at the moment who are deciding not to go and raise money, like sell shares now, or hopefully not for 12 months, and use debt now to get through this period until valuations correct a little bit more. So there's many different types of capital that you can use to run your business, and there's good times to do certain types, and to have a weighted average of all the different types is a good way to look at it.
Yeah, I don't think the data's out yet for how long it's going to take in this environment. I think you've just got to be as prepared as you can and start the conversations like Rohan was saying, like it's a process. You've got to run it like a process, and it'll take as long as it takes. And part of that depends on you and your business, and part of it depends on the investor side. But there's lots more investors in Australia than there were 10 years ago, and that's a positive thing. So I think that's in your favour as well. I wouldn't sort of fixate so much on things that you've got to put in or not put in a pitch deck. I'm always a big fan of a shortish kind of pitch deck, 10 or so slides. I've seen ones that are 40 pages. I've seen ones that are 100. Like, dirty secret, we spend about as much time on a pitch deck as we do to drink a coffee. It's like 4 or 5 minutes. So, you use that and as your guide about how much material, and try to just use it as a way of having a conversation about the business with investors.
And this is going to be the last question before we head into a 15-minute break. So there's heaps more coming through. Okay, so my last question is actually, what is the best way to get in touch with investors right now? How can they stand up from cold emails or LinkedIn outreach, and how can the founders actually contact you?
Tractorventures.com. We'll talk to all of you.
Yeah, I mean, we've got a process on the website. We're on LinkedIn. We're on Twitter. It's easy to find us. Standing out, I think, is about like showing something in this harder environment that that others can't demonstrate. So usually that's things like customer growth, but it might be something else. You show us what you think is interesting and important in the market that you're addressing.
Yeah, I mean, a few years ago, it used to be that all the VCs said, if you want to speak to us, you need to get a warm introduction. And everyone realized that was pretty stupid, because it meant that if you weren't connected to anyone who could give you a warm introduction, then you didn't have a chance of raising money. So that thankfully has finished, but you can submit pitch decks online for all of our companies. And the other thing you can easily do is reach out to our portfolio companies, do due diligence on us. Speak to them and say, hey, look, do you think Skalata or Tractor or Archangel is going to be a good investor for me? I mean, most of them will be happy to have a quick chat with you or an email exchange, and then also potentially say to us, I've had a chat with so-and-so, they might be a good person for you to have a chat to. So there's tons of ways to get in touch with us.
Thank you so much, everyone.